Okay, so we can start. Last time we were looking at the stages of audit. We're looking at the stages of audit. So can you tell me some of the stages of audit that we looked at? Yes. Please, who is talking? Or we didn't learn anything last time? Our meeting on Friday. Hello. Okay. So let me just start. Last time, we started by looking at the stages of, or where we ended, we were looking at the stages of an audit. And we said when we appoint the auditors, they need to plan the audit. When they plan the audit, they need to understand the entity during the plan. When they understand the entity, they need to also to assess or to do risk assessment. They need also to do risk assessment for them to understand the type of risk that they are likely to face in their audit. So, in understanding the entity, what they normally do is that they need to know the operation of the entity, get to know the structure of the organization in terms of its ownership and the corporate governance. Then as well too, they need to understand the business model as well as the business risk that is likely to increase their risk of assessment. Then as well, that's when they are assessing the financial statement. Now, another thing also they need to consider is the industry factors. So for instance, if they find themselves in a standing entity, they consider the industry factors. So if the business finds itself in the financials, if it finds itself in the banking industry or the insurance industry, what are some of the factors in the industry that they need to consider, the auditors need to consider when they are going to audit this particular client? And what are some of the regulations that they will be subject to, or some of the rules that they will be subject to? And these regulations, how these auditors need to adhere to them, they need to also to understand. Then as well too, they need to also look at some of the applicable reporting framework. So understand what the entity is using in the preparation of their financial statement. Because we have established that there are 5 main financial statements. So we need to find out whether the entity has really complied with the financial reporting standards that they are supposed to use. And then as well too, if there are any changes in the new IFRS they are using, whether they have adhered to them. So these are some of the issues under this applicable reporting framework. They also need to have understanding about this internal control of the organization. So the systems of the internal controls. We will look at internal controls later, but we are saying that how the extent to which the organization conducts their operation we need to also look at all those things and also understand the control environment of the organization, so the client. So if we are looking at the control environment, we're referring to how the internal controls are relevant to the preparation of this financial statement. Okay, so based on this, we want to continue with the rest of the stages. We want to look at the next stage called risk assessment. So we will look at risk assessment. Risk assessment. So this risk assessment is like a procedure that when they are going through the audit process, the auditor needs to follow. So it is a procedure they have to. So I'll call it risk assessment procedures. So these procedures, what are the things that the auditor need to follow? So these audit procedures are designed such a way that the auditor will be able to identify and then assess the risks of material misstatement. So when we are looking at the risk assessment procedure, they refers to the procedures or the audit procedures that have been designed. So audit procedures that have been designed to identify and assess risks of material misstatement. That is what happened. So the things that the procedure that it has to go through to be able to identify and assess the risk of material misstatement is what we call the risk assessment procedure. And what are some of the procedure? They can do inquiries. It's a type of procedure. So this is where they do inquiries of the management. They ask questions. So they need information from what? From management, in terms also from internal audit of the organization. So inquiries about of management, and then as well to others. And the others refer to the internal audit of the organization. So one way or the other for them to identify and assess the risk of material mistake is to do inquiries. So it also includes inquiries of management and other things, so that they are likely to assist them. So when they do these inquiries, this inquiry is likely to assist them to identify if there is risk of material misstatement or there is no material misstatement. Another thing also they can do is analytical procedure. So we have analytical procedures. And this analytical procedures is just helping you to identify unusual transactions that will have audit implication. So they do these analytical procedures to try as possible to help them identify unusual transactions or events or maybe trends that are likely to affect the audit process or that could have audit implication. Another procedure also they can follow is observation. And this observation is where they try to look at the documents, the assets, so that they can probe further and also try to find information. So here I can say observation and inspection. So this is where the auditors try as much as possible to observe for themselves if the organization really have the assets they have stated in their books, as well as to any evidence to prove the transactions that they have recorded. So they will sometimes they will require such documents to further understand some of the transactions that have been recorded. So when this procedure is duly followed, at least they are able to identify the risk of any material misstatement, or try and see whether a risk of material misstatement exists in the books of account or the financial statements that management have presented. Now, know that when risk of material misstatement exists, it could be as a result of maybe a misstatement which was occurring. So when risk of material misstatement exists, it means that there is a possibility. So exists means that there's a possibility of maybe, or there's a likelihood of misstatements being happening. That is the reason why we have risk of what? Material misstatement. So when risk of material misstatement exists, it could exist when there is, or risk of material misstatement could exist when there is possibility. When there is possibility of one misstatement occurring, or the likelihood of misstatement happening. So when misstatement is occurring, that is where there is a risk of material misstatement. Another thing also is when the material what has occurred is material. When it says it is material, it means that the magnitude is so high. So we can say that it's being material if it were to occur. So risk of material misstatement exists when there is what? A possibility. And note that this possibility, I might say, must be reasonable. This possibility must be reasonable. Reasonable possibility of misstatement occurring. And then as well to, it is being material if it is what? To occur. And when you say something is material, it means that the magnitude is so high that if auditors does not pay attention to it, it can affect the opinion that they are likely to do, or their audit processes. So that is what happened. Now, when there is risk must be assessed at two levels. When you see that there is risk, it means that the risk must be assessed at two levels. So I can add here by saying that when there is risk, it must be assessed at two levels. And I'm going to discuss these two levels for you. And these two levels are that they can assess it at what? The financial statement level, financial statement level, and then two, the accession level. So note that. So financial statement level and the accession level. And I'm going to explain why we are looking at the financial statement, because you are looking for if there's risk of material misstatement. Now, When you see that there is risk, you need to ask yourself, is it coming from the financial statement or it is coming from the assertion level? Now, with the financial statement, whether it is relating to the whole financial statement that they have prepared, and we know the 5 financial statements. So whether the risk is likely to affect the whole financial statement or just only a portion. So when it is affecting the whole financial statement, it means that there's a possibility that management have override the internal controls that they have put in place. That is what must note. But if it is the assertion level, then we are looking at different class of transactions that had occurred. So maybe a transaction has occurred, this type of transaction, let us look into it, whether the risk that we have identified is likely to affect the whole processes, or it's likely to affect just an aspect of the audit that we are taking. And then as well, to maybe it's a balance that maybe they couldn't balance it all, and then the auditor think that that account balance is where the risk of material misstatement exists. Then as well, maybe some disclosure. So when we look at the assertion level, we are just looking at maybe the assertion level relating to maybe classes of accounts or classes of transactions. Maybe account balances and sometimes the disclosures. But we think that, okay, based on what the management have provided to us, we think this aspect is risk, or there is risk. So we need to assess those, all of them. So this is where the risk assessment procedure goes to. So first, there is a procedure that it is identified, or it is designed to identify and assess the risk of material misstatement. And this one could be done through maybe inquiries of management and others. So internal auditors try to provide with an information, doing analytical procedure. And I said that this analytical procedure is trying to identify this unusual transaction. So trying to identify unusual transaction. Unusual transactions. So trying to identify unusual transactions that is likely to affect the decision of the auditors, or the opinion of the auditors. That is what will go on. Then also sometimes they do observation and then inspection, trying to see if maybe there is any material misstatement. If there is any material misstatement. So that is what normally happens. Then we also said that when there is risk, it must also be known that when there is risk, it can be at 2 levels. Either the risk was found at the financial statement level or at the assertion level. And you say the financial statement is that whether the risk is affecting risk of material misstatement affects the whole financial statements we have prepared, or it is just some classes of transactions that is affecting them. Now, let us look at the next thing, that is audit timing. So that is when they want to go for the audit. What are the issues? What are the things that they need to go through so that they conduct the audit successfully? So let's look at audit timing. So now, When we are talking about the audit timing, it is when they are planning the visit or planning visits, when they are planning to visit. So maybe they have been appointed as auditors. Sometimes they want to visit before the organization prepare the financial statement, so that they will try and look at their procedures. So in this case, they are just going to do an interim audit of some of their documents and systems that they have. Then as well too, they also have the audit timing when it is a year-end procedure. They're going to look at the year-end procedures. So most often, they're planning the audit, or when they are planning the visit, they normally visit within the accounting year. That is from January to December. So this time, they try to look for more details to conduct the audit. So they'll be there. They have been appointed as auditors. They say, okay, since we are appointed as auditors, we need to visit the company and look at some of the procedures that they have been doing, or some of the things that the systems that they have, so that they will have understanding about what the organization does, so that when they come there at the year end, they will now begin to look at the things that they expect to have. So with the end year procedure, it normally happens at the 31st December. That's when the year has ended. Now, when the year ends, that is when they now come and conduct the final audit. So with the planning a visit, they do interim audit. Try to look at the documentation system that they have, the procedure test they need to do. But with the final audit, when they come, what they normally do is that they do more checking. They do more direct checking. And this is after the year has ended. So more checking of balances. That is what they do. So the first thing so with the timing, I'm explaining again that the first thing that happened is this planet is to what? Is for them to at least call. So when they call, they will visit. So they visit the client first to understand the nature of what they are. And when they contact the client, what they normally do is that they want to know whether the audit staff will be willing to visit the place, looking at the way the organization is. Then as well too, they want to inquire about some of the changes that they have in the organization. So that is what they normally do there during the time of the audit. That is what they do. Now, when we talked about this understanding the organization as well to doing the risk assessment, we talked about when there is risk, it must be assessed at two levels: the financial statement level and accession level. So now, if they are planning the audit, they are going to also to assess if maybe they can identify some risk. If they find out that there is risk, and this risk is either relating to the financial statement or the accession level, then they can now have their audit opinion. Now, with this established, we can say that if there is risk, it means that possible it's likely to affect the opinion of the auditors. Now, there is something we call audit risk. audit risk. So this audit risk is normally used in the processes of audit. So it's mostly a technical term they normally use in the auditing process. Now, what should be known is that this audit risk, there is no way you can reduce it at all, because this risk is something that is related to the process of conducting the audit. So it's a term that normally, but note that there is no way this audit risk can be reduced at all. No. That is the reason why the auditors cannot provide absolute assurance. They only provide reasonable assurance. So because there is audit risk, this risk is forcing the auditors not to give what? Absolute assurance, saying that everything is like that or everything is okay. No. Because of this audit risk, because you can't reduce it to zero. But that's why they mostly give what? A reasonable audit. Now, there are some of the issues that we need to understand about this audit risk, because this audit risk has some, when an audit always has some inherent limitation. An audit has an inherent limitation. And this limitation is likely to affect the decision or the opinion of these auditors. Now, what are some of these inherent limitation, or some of the examples of this inherent limitation? Sometimes the nature of this financial reporting, that is the financial statement. So we have the nature of financial reporting of financial statement. So the way the reporting was done can have an inherent limitation. And this inherent limitation is likely to affect the judgment of the auditors. So the nature of report, sometimes they may be using, because most of us are accounting students, is the method that they adapted. Did they use the correct accounting method that they are supposed to use? If they are supposed to use the straight line method, what type of estimate they were doing for in terms of the percentages? When they are supposed to use reducing balance method, how did they come about with their percentages that they use to compute the depreciation? That's the reason why we say sometimes there is inherent limitation. Because of that, that's the reason why auditors cannot give absolute assurance, but they can only give what? A reasonable assurance. They can only give reasonable assurance. That is what normally happens. Now, so the nature of the reporting of the financial statement, and sometimes to the audit procedures. The audit procedures. Now, audit procedures are mostly are designed to gather evidence. That is what you must note. But sometimes the audit evidence, that the way it is designed, it may not be able to detect intentional misstatement. So though they are conducting the audits that they have conducted, they are able to tell us that, okay, when we conducted the audit, we saw that everything is okay. But sometimes with the audit processes, though they have come out with their procedure, and the procedure is meant to to gather evidence. But this evidence that they are trying to gather, the procedures may not be able to gather intentional misstatement. That's the reason why we say that this inherent limitation can bring about this audit risk. Because audit risks, we are saying that they will not be able to identify all the issues. So that's the reason why it is informing the auditors to give a reasonable assurance. Because one, maybe the nature of reporting of the financial statement, there can be an inherent limitation of which they may not be able to identify the errors in them, as well to the audit procedures that is designed such a way to gather evidence. Sometimes very, very difficult to detect intentional misstatements. And sometimes to as an audit needs to be conducted within a reasonable period of time and also at a reasonable cost, it's not always possible to gather all the necessary information that you're supposed to have. So another thing that brings about the limitation is that when we go into a company, because of the cost involved, we cannot do everything. We cannot say we want to inspect all the staff in the organization. We can't say we want to inspect the financial statements, all of them. We can't say we want to check all the assets in the organization. Because of the money involved, they will be able to do certain aspects and leave certain aspects. Unless otherwise, you are paying so huge. You are paying the reason the cost is so huge such a way that it is affecting. You need to look at every aspect on organization, and that thing it will cost the client. So, for instance, your school, if maybe your headmaster this or maybe the board of the school decide that they should come and audit your school, and then they say they should come and audit everything. If they will audit everything, it is expensive. You have to pay huge amount of money. But what will happen is that if they intend, they tell them that, okay, we have this amount of money. Can you audit this aspect? Can you audit aspect? And they say, yes, we will take this amount of money. That is fine. Then what it means, they will look at an aspect and they will leave the rest. Because they are leaving the rest, that's the reason why we are saying there is an inherent limitation. Because they will not be able to cover everything. That is the reason why I said that audit risk cannot be reduced. Audit risk cannot be reduced to zero. No, it cannot be reduced to zero. So that's why I said that is why auditors cannot give absolute assurance, but they give reasonable assurance. Why? As I said earlier, I'm repeating myself, because we cannot do everything. We cannot do everything. That's the reason why it is happening that way. Now, if we now understand this inherent limitation, we should note that when you are conducting the audit, we pay attention to this audit risk. And this audit risk is mostly considered throughout the audit. Because audits, when they are doing the audit, they do it in stages. So when they are conducting the audit, they consider the audit risk throughout the audit. They consider throughout the audit, especially when they want to understand, the entity. So understanding of the entity. If they want to understand the entity, they do that so that they will ask themselves, what are the risks? What are the risks? And then as well too, when they are planning the audit. When they are planning the audit. So audit risk is assessed throughout the audit, especially when they want to understand the organization, as well to when they are planning the audit. So in understanding the organization, we always say that there is a standard that governs trying to identify the audit risk. So there is a standard that governs it. And the name of the standard is, ISA. And this ISA is called Identifying and Assessing the Risk of Material Misstatement. So IAS 315, that is identifying and assessing the risk of material misstatement. So this standard guides them, because if they are understanding the entity, they want to know what the risk involved. So in that's during the audit risk process, they want to do that, because we said audit risk should be considered throughout the process. So if they are trying to identify that, they use this standard to guide them. And then when they are planning to, they need to understand the audit risk. Now, so then, what is this audit risk? When we talk about the audit risk, it is the risk that the auditor gives an inappropriate opinion on the financial statement. So, audit risk is the risk that the auditor gives an inappropriate opinion on the financial statement. So the risk that an auditor will not give a good opinion about the financial statement is what we call this audit risk. Because note that this audit opinion that the auditor is giving must be fair in all material respects. So if you are expressing your opinion, remember that audit is an independent examination. So yourself, you can even conduct an audit where you do an independent investigation or examination. Then later on, you express your opinion. So the risk that is associated of you not giving the right opinion is what we call the audit risk. That's the reason why I stated earlier that the audit risk is really of concern to the auditors during the audit process, because the risk that they will not give the right opinion lies over here. If they are not able to give the right opinion, it means that the audit risk was so high. Note that. Now, the audit risk is a function of two risks. That is the risk of materials misstatement and the detection risk. So the audit risk is the function of two risks. And the first one is risk of material misstatement, and two, detection risk. So if you want to get audit risk, it is risk of material misstatement and detection risk. So when we talk about risk of material misstatement, it's looking at the risk that the financial statement may contain what? Material misstatement. So here you're looking at the risk that financial statement, or let me say drafted financial statement, may contain material misstatement. That is what happened. Then when we look at the detection risk, it is just saying the risk that the audit procedures will fail to detect the financial, the misstatement in the financial statement. So the risk that audit procedures fail to detect fail to detect material misstatement in the financial statement. So the risk that the audit procedures will fail to detect material misstatement is what we call detection risk. Okay. Any question from this? So we are going to look at them one by one. So I said it is the function of two risks: risk of material misstatement and detection risk. So the risk that the balance sheet may contain errors or misstatement, or the statement of financial position will contain that misstatement, is what we call risk of material misstatement. And the detection risk is the risk that audit procedures fail to detect material misstatement in a financial statement. So these are the two risks, or the two risks, the two risks of this audit risk. Now, let's pick the risk of material misstatement and go into it further. So risk of material misstatement. So when we say the risk of material misstatement, we establish that is the risk that the financial statement may contain what? Material misstatement. Now, there are two components. And the components are inherent risk and control risk. Inherent risk and control risk. So in the risk of material misstatement, there are two components: inherent risk and then control risk. So when we are looking at this inherent risk, then is the risk that there is a material misstatement that could be material. So when we talk about this inherent risk, is the risk that there is material or there is misstatement, or there is a misstatement that could be material. So this that could be material. Sometimes when we look at the internal controls of the organization, these internal controls are such way that it is not able to identify and then trap the risk, the material misstatement. So when we talk about risk, I'm talking about this material misstatement that auditors normally see. So it's not the normal risk that we say, this thing is risky, this one is. Auditors have their own terminologies. That's why it's a technical term that we normally use in audit. That when we talk about inherent risk, it's a risk that there is a material mistake that could be material, and that there was no related internal control that was able to detect this material misstatement. So if I am continuing the sentence, I can say that if there were no related internal control which maybe could identify and trap that misstatement. So the organization didn't have an internal control to trap all this inherent risks. So sometimes the complexity of these transactions that they have entered into, the transaction is so complex such a way that they are not able to look at whether there is an inexperienced staff. So because the transaction was so complex, they didn't understand. In such case, we have an inherent risk there. So sometimes the transaction is such a way that there's pressure to complete that transaction. They didn't look at whether the staff were experienced to handle that transaction, or the people who took the decision did really investigated into the issues before granting the permission for the transaction to take place. In that case, because the internal control was not able to identify and trap the misstatement, then we can say the risk is inherent, or we have inherent risk. Because looking at the nature of the transaction, we couldn't identify any internal control that was present for the organization to use to assess if there could be a misstatement or there is no misstatement. In that case, the risk that there is no related internal control to detect that is what we call inherent risk. Now, there is also what we call control risk. So the control risk is such a way that the material misstatement may have occurred, or have been occurring, and there is nothing that could be done to prevent it or detect it by the systems that they have. So what it means is that we can say that this is a risk that material misstatements have occurred and will not be prevented or detected or corrected by the system of internal control. So this one is not that maybe it's not the inherent risk, but just that the systems that they have could not detect and prevent the misstatement happening. That is what we say it is what? It's a control risk. So that is what happened. So I can type here by saying that. So in short, I can say the risk, so that you can write it down by saying the risk that the material misstatement having occurred will not be prevented or detected and corrected by the system of internal control. That is what happened. That's the meaning of the control risk. So with the risk of material misstatement, we have the inherent risk and the control risk. Because most often, when they design the system, they expect the system in such a way that it should be able to detect and then correct all the misstatement that may have. Okay. But if the system that they have is not able to prevent and detect, that it means that there's a control risk. That is what we have. So risk of material misstatement, we have two components: inherent risk, control risk. Now, I've already talked about this detection risk, that is failure for the auditor to detect material misstatement in the financial statement. So detection risk is not part of what that, but it is also the another form of risk, because I say it's a function of two: detection risk. Detection risk, we are just saying that failure of the auditor to be able to detect what risk of material misstatement. So that is what we have for detection risk. So because I mentioned it's a function, so we can say that audit risk we can say that audit risk is just the addition as also. So audit risk is just equal to the inherent risk times the control risk times the detection risk. That brings about this audit risk. Because I mentioned by saying that if you go to the previous slide, I said audit risk is the function of two risks, and the two risks is found over here: inherent risk, which forms what? The material misstatement, risk of material misstatement times what? The detection rate. So when you do that, and then you'll be able to get the audit risk. Now, with this detection rates, sometimes we can also have sampling risk and non-sampling risk. Sampling risk and non-sampling risk. Now, when we talk about sampling risk, it normally arises when the audit procedures are applied to samples rather than just the entire population. So when they go into the organizations, when audit the company, they will just pick an aspect of the organization to audit and leave the other aspect. So the other aspect they couldn't pick, or the other aspects that they pick, the most often the auditors are faced with this sampling risk. It's possible that they couldn't pick the right samples to work with. That was the reason why they had this detection risk. So sampling risk is just a risk when audit procedures are applied to samples rather than what the population. So the auditor can just conclude that based on the samples I checked, so based on the samples that I had control over, this is my opinion. In that case, there could be detection risk, because the auditor can decide that I think the payroll system, there are ghost names over there. So that is where I want to audit, leaving the other aspect. So the risk associated with him not be able to what detect the material error is because of what? The type of sample that he made. That's the reason why he couldn't detect the error. So he can also come and say that I just want to audit the beza because I think the beza of the school has been spending some amount of money or have been taking food, some of them foodstuffs to the house. So because he decided not to pay attention to the payroll, but decided to pay attention to where the business office to audit. That's the reason why we are saying there is sampling risk. So now we have non-sampling risk, and this risk normally arises from reasons other than the actual sample size that you choose. So because maybe your audit staff were inexperienced to be able to detect the areas that the risk was high, or the audit procedures that you updated was inappropriate. So because of that, it affected the detection rate. So as I said, sampling risk is because of the sample you selected. But the non-sampling risk is looking at other risks other than the sample risk. For example, you not having appropriate audit staff to conduct the audit, you not having the enough resources to conduct the audit. All these things form part of what? The detection risk. Detection risk. Any question?
Yes, sir, Doc.
Yes, please.
Yes, Doc, I want to find out. So, is it when you want to employ the services of the auditor, is it the client that determines which sample to audit, or the auditor that determines the sample?
Okay, thank you. When you want to audit, we need to, the auditor will now have to, because there's an engagement letter. The engagement letter, last time I explained. So let me show you the things of the engagement letter. I said it will talk about objective of the audit, tell the responsibility for the management responsibility for the financial statement, tell us the scope of the audit, including references to legislation and professional standards, and a form of audit. So here, this is where it comes in. So with the scope of audit, together with the client, they will say that you are come to audit the organization, but then we think we want you to audit the financial statements for us. So the financial statements that they say audit, the auditor now decides that, okay, based on the transactions that is going on, I think I have to look into this aspect. I think I have to look at the payroll, because looking at so you try to identify the areas that it can affect its opinion. That's the reason why we said the audit risk is related to the audit. It's a technical term that mostly related. So they think this area is more risky. So it is the auditor who decides that this area is risky. Let me look into it. This area, I need to put more stuff in so that I reduce the risk. At the same time, I reduce because I cannot reduce the audit risk to zero for me to give an absolute assurance. I can only give a reasonable assurance. So it is the auditor who say that, let me go and audit this aspect, this sample, so that it reduces the detection risk. Because the detection risk is a risk that the auditor fails to detect material error. So in order to avoid the situation whereby he will fail to detect the material, then you go into where he thinks is more risky. So when the auditors come, it's not a client. The client will just say, audit the financial statement for me. But then they will now decide where they want to audit. Please, are you okay?
Yes, Doc. Doc, let me ask again.
All right.
Is it the case that the audit will be carried out, but because of the audit risk, the problem or the issue, let's say financial malfeasance, will still be there? The accountant may have the control, the internal control of still keeping on with his activities.
Okay. So what happened is that when they conduct the audit, or before they conduct the audit, we talked about risk of material misstatement, which is a component or which is a function of the audit risk. And we said we have the inherent risk and the control risk. Now, with the control risk, the business may have internal controls, but these internal controls was not able to prevent and detect the material misstatement we are talking about here. In that case, the control risk is high. It can affect our audit risk. But this risk we have seen, after realizing that there's material misstatement, we can now inform the management that, or the people who ask us to audit that, based on what we have seen, we think that the internal controls are not so strong to prevent this malfeasance you use or the material misstatement that is occurring. So we are suggesting to them that they should do it this way, hoping that it will change. Because there are times that the auditor may have said this is what is going on, but then the accountants may have not changed his ways of doing things. The auditor can even propose that, based on what the accountant is still doing, we think the accountant should be removed because the accountant is not doing the right thing. And the shareholders or the owners of the business will advise themselves based on the auditor's report. So there are times that they may have audited the company and they have identified that the controls are no good. So then they will advise the company that this is what we think. But as I said, those advices or those presentations that they do, or when they read management to talk to them, some of those things, they don't put them in the report. They don't put them in the report for us to see. They will just mention them for them to know that this is how it is. It's only the Public Accounts Committee where, when they put the things in the audit report, That is when, and then it's some of the presentations. So some of the things they put it in the audit report. Some of the issues they draw the management attention, they don't put it in the report. You just advise them on it, or they tell them that we think we should do this, and it will help the process. So in that case, you don't see it there. But the things that they want to make known, or they want to put it down, document them, they will let others read them to them know about it. So there are times that there could be misstatement even after the auditors have drew their attention about that. But it's all about the auditors telling them that there's material misstatement, that because of that, it affected the processes, or there's material misstatement, or this is our opinion about the financial statement, because auditors need to express their opinion whether the financial statement is free from material misstatement. So if they say it is not free with material misstatement because the accountant is still doing what he's still doing, then shareholders need to advise themselves about it. Senior, please, you do understand my explanation?
Yes, sir. Yes, sir. That's right.
Okay. So we have talked about this risk of material misstatement. We have also looked at the detection risks, and we said that most often the risk of material misstatement may actually exist at where the financial statements level and the accession level. I talked about them here. That it could be as a result of the financial statements level and the accession level. And auditors must respond to the financial statement level as well as what the accession level. So most often when they are auditing the organization, I told you that they pay attention to international standard of audit, or international auditing standards. We will call it international auditing standard, or we will also call it standard of auditing. International auditing standards, or some will call it international standards of auditing. Okay, so international or auditing standards, or international standard of audit, it has been revised. This has been revised. So let me talk about this standard, then we can go forward. So this standard has been revised, though the name still exists, but it has been revised, and it was revised in 2019. So revised in 2019. Now, they are saying that this standard introduced the concept, or it introduced certain definitions that normally assist auditors in identifying the risk of material misstatement. So these standards come up with some of the concepts, some of the definitions that normally guides auditors in the assessment of risk of material misstatement. So in the standard, they talked about inherent risk. Inherent risk. So we are just looking at some of the conditions we think can affect the can bring about material misstatement. Then as well too, it also look at the spectrum of inherent risk. Inherent risk. That is looking at the degree to which inherent risk varies. So let me say about this one is degree to which inherent inherent risk varies. Then, as well too, it also look at the significant risk. The standards talk about this significant risk. These are concepts that can be found there. And this significant risk is referred to a risk of misstatement, which is close to the upper end of the spectrum of what inherent risk. So I can say hereby say it's a risk of misstatement which is close to the upper end of the spectrum of inherent risk. That is what we need to know. But then, if they realize that things are not going well, sometimes they do what we call substantive procedure. I've already talked about um, uh, I've talked about analytical procedure. Who can explain analytical procedure for me? What I said about analytical procedure? Because when I was looking at, I talked, we trying to find when there is risk. I talk about, or when there's risk assessment, I talked about inquiries of management and others, analytical procedures, and observation as well as inspection. So what do you mean by saying analytical procedure? If you're doing analytical procedure, what are you trying to do? Who can tell me that? Analytical procedure. Yeah.
When you are doing the analytical procedures, you made mention that that is where you try to identify or find out if there is any unusual transactions that has taken place.
Thank you. Thank you. So if you are trying to identify any unusual transactions that have taken place, we are saying, or unusual transaction in the financial statement that have taken place is what we mean by analytical procedure. Right. Thank you. Now, since you have been able to do your risk assessment, and then you have tried your possible best to reduce the audit risk, there is also another aspect also we need to pay attention to. Because if you are trying to detect or assess the risk of material misstatement, you need to get evidence of the transactions that took place. So we have what we call audit evidence. Audit evidence. It's another key term we need to understand. Audit evidence. Now, we know that when you are gathering an information, you need proof of certain transactions so that you can come out well with your opinion about whatever has happened. So you need evidence. And auditors gather audit evidence. And this gathering of audit evidence go through procedures. So we have audits or gathering audit evidence procedures. That's if we want to gather or want to verify some of the transactions, we have a way of what? Gathering the evidence. Now, in gathering the evidence, you can do analytical. So the procedure, you can do analytical procedures. Trying to identify unusual transaction. When gathering the evidence, you can do inquiry and confirmation. That's another procedure you can use to gather the evidence. That is, you're asking client how or checking how the goods that they have received, even asking third parties to confirm certain balances. So sometimes if the business have a bank account in a particular bank, the auditor can even phone the bank and ask the bank, did this transaction did you really approve this transaction for this amount of money to be taken out from this company's account? So they do inquiry and then confirmation of certain transaction. Another way of gathering the evidence is that they do inspection. So inspection, that is where they do inventory count, physical inventory count, or physical count of this non-current asset that the business have. So the plant, the equipment, the vehicles that the business has, they do inspect to gather evidence. Another way of gathering again is observation. Another way of gathering evidence is what? Observations. And this is where maybe they try to watch the staff, how they 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 write certain transactions in the books of account. Then as well too, if they happen to have a warehouse, they watch the staff, how they carry the goods there, how they book the transactions, if they issue out some of the things from the warehouse, how they record them. So they do observation. That is what they do. Then they also do another way of gathering evidence is they do recalculation. Or they do reperformance. Reperformance. So that is where the wages that they have paid. So sometimes the calculations that they have done, they sit down and then they recalculate everything again to see whether they have done the right thing. That is a way of what? Obtaining audit evidence. That's a way of obtaining audit evidence. So now we have known the various processes to obtain audit evidence. So then the question is, how much audit evidence is needed? Now that we've known the processes to gather the evidence, we ask ourselves, how much audit evidence is needed? So there is a standard that governs that, we call it ISA 500. ISA 500 states that evidence should be sufficient. Evidence should be one, sufficient. Then two, it should be appropriate. Evidence should be what? Sufficient. And two, it must be appropriate. So when we say evidence should be sufficient, what it means that the evidence should concern all the it's concerned all the quantity of audit evidence that we have obtained. So sufficient doesn't mean we should do everything. No, at least it should concern, or it's concerned about the quantity of audit evidence that you need. The quantity of audit evidence. So audit evidence being sufficient is referring to the quantity. Then audit evidence being appropriate is concerned about the quality of the audit evidence. Quality of the quality of audit evidence. So if you are looking at the quality of audit evidence, we are just paying attention to the relevancy and the reliability of this evidence that you have obtained. The relevancy of this evidence that you have. That's why I'm talking about the quality. So quality, we are looking at the reliability and the relevancy of the audit evidence. That is what we must note. Now, let us note some key things. So let me state some key things over here for you to understand. That external evidence is better than the entity's evidence. So note something under here. Note that external evidence is better than the entity's record. Because you know the way accountants are, sometimes they can hide the actual evidence and produce some evidence for you. So what you can do is that if you want to confirm certain transactions, you can confirm from third parties. So we can look out for the bank statement and look at what the bank statement will actually give the actual transactions that has taken place between the company and the other parties, especially if they use the bank as a mode of payment, as in they issue checks for people for payment, or if people pay money into, if people want to pay for their transaction, they pay into the bank account. If you are using that, we are saying that external evidence is better than the entity's record. Another thing also I want you to note, which is very, very important, is that evidence obtained directly by the auditor is better than the evidence passed on by the client. So evidence obtained directly by the auditor is better than evidence passed on by the client. So most often the client will just give something, but then if the auditor was able to obtain an evidence from the transaction that has taken place, we can say that one is better. Again, note that audit evidence is better if there is effective internal control. So note that audit evidence is better if there is effective internal control. If there is effective internal control. So this actually ensures that it rather reduces the risk of fraud and error, because if the internal control is effective, you not see errors, you not see fraudulent activity taking place in the organization. Another thing also you must note here under this audit evidence is that written evidence is better than oral evidence. Please, looking at this, me saying written evidence is much better than oral evidence, can you explain why I'm saying this? Assuming I want you to contribute to this. Why do you think written evidence is better than oral evidence? Based on what I've written, who can say something about it?
So for the written evidence, there is something that is backing it that the person cannot say, I did not say it. But with the
Yes.
oral, the person can even say, I don't think I said this one. But with the written one, there's something to show. Thank you.
Thank you. So, oral evidence is not with the paper that we are producing as well as an evidence. So, if you say that I did this, and you look into the paper and it is not that, it means that we cannot conclude about the actual thing that has taken place. But you see, we always say paper does not tell a lie. So if everything is written, then it is better for you. That's why even if nowadays people, when the transaction takes place, they even scan the document down because they think that maybe even if it's printed at some point in time, it fades out. So they want to scan them out, especially when you go and buy something from the organizations that they print the small like the Melcom, the supermarkets. When you buy things from them, that small paper with time it will fade. Or when you buy electricity prepaid, you see that with time, you see that you cannot see the figures again. So it's better to scan them. So it is on the paper and then you have scanned it and it is there. When they can easily look at that. So that is the reason why they do that. Then another thing also I want to say over here as part of the evidence is that originals are better than photocopies. Originals are better than originals are better than photocopies. Originals are better than photocopies. So, though, because nowadays scanners are there, they're able to scan the original ones and put them for you. So when you see, you can see that the evidence of sign. But then when they produce the photocopy for you, it's not good. It's not good. So this is what happened when they have this audit, that external audit is better, external evidence is better than the entity's records. Evidence obtained directly by the auditor is better than the evidence passed on by client. Audit evidence is better if there is effective internal controls. Then written evidence is much better than oral evidence. And originals are better than photocopies. So now, let us understand analytical procedure, because analytical procedure is a way of what? Gathering evidence. So we are going to pick them one by one and go into details. So let's pick analytical procedure that you were trying to identify unusual transaction. Let us go in further and understand what do you mean by analytical procedures. So now, analytical procedure is mostly used to evaluate the plausible relationship between financial and non-financial information. That is what happened. So when you're looking at analytical procedure, most often it is used to evaluate the plausible relationship between financial and non-financial data. Even involve you trying to do calculate the ratios and comparing the amount to maybe last year results, budgeted results, or maybe industry standards. So let me do some small write-up here for you to see, saying that analytical procedures are used. So they are used to evaluate plausible relationships between financial and non-financial data. And it's also it includes calculating ratios and comparing them to previous year results or industry standards or budgets. So every organization, they try at their possible best to plan for the future. So they prepare a budget. So when we do analytical procedures, we are trying to just compare the financial data and non-financial data. So we are trying to see whether there is unusual transactions that we can do. We can understand some of the issues from there. Now, analytical procedures can be used in the stages of audit. Note that analytical procedures can be used in the study or the stages of audit. It can be used during the planning stage, that is planning the audit. It can also be used during the substantive procedures. Substantive procedures and it can be used during the final review. So note that analytical procedures are used. So let me type here, procedures are used. Are used at the stages of audit. And after they have the planning stage, the substantive procedures, and the final review. So in the planning stage, if they are doing this analytical procedure, what they normally do is that they will try to look at the previous year, maybe the inventory. They look at the previous year inventory, and then they will say, okay, this time our attention will go over there. So then when they do the competition, they will look at, okay, the inventory days and the number of days they keep their inventory, maybe let's say 44 days before they sell them. So let's see whether the 44 days has reduced maybe 10 days or it has increased maybe 60 days. So during the planning stage, they'll do the computation to find out if I know or you did business finance and it is possible you treated financial statement analysis or ratios. Please, did you do that?
Yes,
Yes,
sir.
sir.
Thank you. So it means that Dr. Christopher Otu taught you that. Okay. So when they compute this inventory holding days, they'll be able to compare to their previous one and then tell themselves that, okay, last year, this was the inventory days. They will let us pay attention to these inventory days and then plan the audit towards that place and see whether we can we can investigate into the inventory days. So it's like they are planning the audit. So they computed the previous inventory days, they computed the current inventory days, and they think that the inventory, there is more risk over there. So let us go and look into it. So after doing that, so that's the planning stage. So after doing the computation, that was what drew their attention, that let us pay attention to them. Or they did some ratios and they realized that maybe the interest cover, that is ability of the business to pay its interest, or the number of times the business pay its interest. So if the interest cover is so high, then they ask themselves, okay, if the interest cover is so high, then it is good because the business may have enough profit to pay for the interest. That is fine. That's if he's going for loan, can pay for the interest. So maybe the interest cover at the interest side, the loans is not a problem. But when the interest cover is so low that the company, it takes a while, the number of times it can pay for the interest is very, very low, like one time, two times, then it means that no, they have to look into it and look at, have they gone for more loans, and what were the procedures that they used in getting the loans, then what are their revenues. So they now have to do the substantive procedures to understand that. So with the substantive procedures to, what they actually mean is that it is something that was mostly designed so that at least we can get some material basis of gathering evidence. So when they do the substantive procedure, what they are actually doing is that they try their possible best that, okay, if last year inventory holding period or debtors collection period and this year debtors collection period, last year was 32 days, this year is 30 days, it means that there is some confidence in the figures that we are getting. So everything is right. So the substantive procedures is they are doing the comparison to see whether indeed what they are having is actually what they are supposed to have. And the internal final review also we do analytical procedures. So here, at the end of the audit partner try and look at the financial statement as a whole and ask himself, okay, based on this financial statement that I'm looking at, is everything okay, or do I have to compare the performance of the organization to that of the industry before I write my final report? So it goes at that place. So in planning the audit, they look at that. Substantive procedures too, they look at that. And the final review too, they look at the analytical procedures. The last aspect of the procedures I want to talk about is the accessions. Another thing also I want to talk about here is the accessions. Then I will end the class because we promise ourselves that at every meeting we will do 2 hours and then we'll continue another time. So we have the assertions. So now, when we were talking about risk, reducing the risk of material misstatement, or when we were looking at the risk of material misstatement, we mentioned that sometimes the risk of material misstatement can be found in the financial statements level and the assertion level. So, in order to reduce the risk of material misstatement to a minimum level, we need to check the assertions that were made. The assertions that were made. And the assertions that were made are the amount of figures in the financial statement. So it is not what management is saying, it's about what management have written in the books of accounts. So they want to check whether the amount in the financial statement, are one, accurate, are two, maybe complete, that is free from error. They are complete, everything has been included. Whether the classification and the presentation was correctly done. That is the amount. So that's what I'm saying, that the items in the financial statement, it comes with amount, like sales. Is a sales figure complete? Is a sales figure accurate? So that is classes of transactions. Are they right? That is what we are looking at. And sometimes the valuations, are they okay? So the amount that we are checking, we are looking at whether the valuations are correct, whether when they were valuing the inventory, they did the right thing. That is what must be said over here. So in gathering the evidence, they pay attention to the assertions. Sometimes they also look at the occurrences of the transactions. Occurrences of the transactions. So that is what we have over here. Any question? Any question? Yes, are you available?
We are fully available, though.
Okay.
So we are here.
All right. So today we have looked at a lot of issues trying to understand the risk of material misstatement, and as well to trying our possible best to understand audit risk. And then we have also looked at audit evidence. So with the audit risk, we said that the audit risk is mostly considered throughout the audit, and that in doing that, we need to understand the entity very well so that we can know the risk there. And also in the planning or the audit tool, we need to do well to look at the audit risk. And we said that the audit risk is a function of the risk of material misstatement and the detection risk. And so the risk of material misstatement, we can have inherent risks and the control risk. So the audit risk, being a function of the risk of material misstatement, is just inherent risk times the control risk times what? The detection risk. That the auditor must try his possible best to reduce the audit risk so that he can give what? A good opinion about the about because the audit risk is failure of the audit to be able to detect material misstatement in the financial statement. So it is very good that the audit risk he reduces it so that it doesn't affect his opinion. But again, in looking at the audit risk also, you also have to pay attention to he trying to gather the right evidence. And we said that the evidence can be gathered through we doing what we call analytical procedures. Analytical procedures. We also doing having or going inquiry and then confirmation. We also having is doing inspection, observation, and then as well to recalculation and that of what re-performance. But we also said that the evidence should be sufficient and what appropriate. The evidence should be sufficient and appropriate. And the sufficient is just looking at the quantity of audit evidence he must gather so that he can use that one to finalize his opinion. And then as well to the appropriateness is looking at the quality of the audit, the quality of the evidence that he has obtained. But we also mentioned that with the analytical procedures, we are just trying to identify unusual transactions. But then analytical procedures happen at all the stages of audit. That is the planning stage, the substantive procedure, and then as well to the review, final review. But we also said that with the analytical procedure, we are trying to evaluate the possible relationship between the financial data and the non-financial data. The financial data and the non-financial data. So when we do that, we are trying to recalculate the figures to compare them with the industry or last year previous results or maybe the budgeted figures. That is what we normally do. So, and then also we ended with the assertions. We said the assertions are the amount of figures that has been made or the classes of transactions that we have in the financial statement. So the auditor, when he's looking at the class of transactions, he should ensure that the amounts are accurate, the amounts are complete, the amounts are well classified and presented, as well as to it is well evaluated. All right. So again, do you have any question based on what we have done today? And our next meeting is on Friday, 6 p.m. We will look at another aspect of the course outline. Any question?
Yes, sir.
All right.
Okay, so Doc, I want to find out in an attempt to the auditor to reduce the audit risk to zero, or
no, we said we cannot
you
reduce
cannot
zero.
reduce it to zero.
Zero, yes.
Yes, but I want to find out in his possible best to bring it down. And you are still not. Let me reframe. My main question is this: is there a situation where a client who employed the services of an auditor will still refuse or not be in the position of giving the auditor the required materials in order for him to reduce the audit risk?
Yes, it can happen. When it happens that way, the auditor will give a disclaimer opinion. It can happen. And the auditor will give a disclaimer opinion that he didn't obtain evidence to buttress his opinion. In that case, he is giving a disclaimer opinion. So you will give a disclaimer opinion. So you give a modified, you write a modified report, but the opinion will be a disclaimer. It's not be even adverse. it will be just a disclaimer. It will be a disclaimer that he did obtain evidence, and he will give his reasons. That and that's all. Because some organizations, you realize I told you that the shareholders or the owners of the business appoints the auditors. When they come and then management refuses to give them the things that they need, they can say they will not give an opinion, or even the opinion when they give an opinion, they think they have to give a disclaimer opinion, and that'll be all. So anything that they need, we should give it to them. If you are not giving it to them, they'll give an opinion, and then they'll just take the amount of money you're supposed to get, and they will just leave.
Oh, okay. Full payment.
Yes. The issue is that when the auditor is agreeing to that, the auditor must agree to the terms and conditions, and you, the client, must agree to the terms and conditions. So before, as part of the engagement letter, remember there is audit fees. You have to pay the audit fees, and then he will give you the terms of the audit, the scope of it. So after giving you all this scope and you refuse to honor your obligation, fine, then pay me my money, then let me leave. And then I'll give my opinion. But you cannot owe the auditor. No, you can't owe the auditor. That one, they will see you, they have performed their services, and so they can sue you at court that they have audited you and you have refused to pay them. Senior,
Okay,
please,
okay.
are
So
you
Doc, it means that in that case, they will also report to the shareholders that the management is refusing to give them the necessary information.
Yes, so in their report, they will state it there. And
Okay.
then as well to remember that I said that when last time we read the one of the KPMG reports, they said that management made their representations. So everyone have to come out, we have to meet, and then the auditor will tell their side, and they will ask questions, and then management also need to speak their tell their also side of the story. Then they'll finalize the decision. So if they are making presentation, management presentation, and auditors are also making reference to the assertions in a financial statement, and then they are not able to give them enough evidence to support those assertions, then they'll tell them that this is our opinion, and they'll write it and they will give it to them. So then the shareholders will now deal with the management and then ask them why they are refusing to give them that. But also, don't also forget that the audit committee that we've learned are also there to help in the appointment of the external auditor. And the audit committee, the board of directors over there on the audit committee, some of them also, so the board of directors some of them are also part of the audit committee. So because based on that, they can also the auditors can also explain to the audit committee and tell them that we are asking for this, but then management is refusing to give us this document. So then if audit committee also comes in and then still management refuse to give them the evidence, then they will tell the shareholders about it. And then whatever they want to do to management, they do to management. And then the company still goes on. Senior, please, are you okay?
Yes, sir. Thank you very much.
You are so welcome.
Doc,
So,
please, Doc,
mhm.
please, can you
Madam Gift,
resend?
yes.
Please, can you resend your slides to her, the one that we just
Yes,
did?
yes. I'll do that. So every day I update the slide. So I'll do that. I'll share with you.
Thank you, sir. Thank you very much.
When you have time to, I think the videos have been uploaded, so you can have time to look at them too,
Okay.
to prepare you well for the future as well as to the end of semester
Yes,
and
sir.
the quizzes.
Yeah. Thank you, sir.
So
Thank you very
thank you
much.
so much for your time. God willing, Friday, 6 p.m. we'll meet.
Thank you, sir. We are grateful.
No, it's okay.